Alright folks, before delving into the deeply technical chapters of 2 and 3, here's a quick run through to correct the terminology we use on a day-to-day basis as security traders. So on the right side we have the PD array matrix with all the different key levels that we look for before entering a trade. Of course, in this hierarchy, the strongest key level or PD array is the bearish breaker and the bullish breaker. Right, so the breaker is the strongest PD array, and you better be having a notebook at hand, writing down everything I'm saying. The most common terms are candlesticks, FVG, breaker, kill zone, especially model number 1, turtle soup, rejection block, and OT. To begin with, candlesticks. Now, candlesticks are nothing more than a visualization of the buy or sell orders in the market at any given chart, at any given moment. Right, so thinking from the perspective of the market efficiency paradigm, a candlestick is simply the market makers injecting in more liquidity, pushing price to the buy side, which results in an up-close candle, or vice versa. They push market to the downside, which reflects in the charts in the form of a down-close candle, which means more sell orders. Right? That's it. So open low, high close, which means the market makers are pushing price higher. Open high, low close, which means they are pushing price and they intend to attack liquidity lower. And as you know, as I always preach, we're looking to trade below the opening price of potentially bullish candles and above the opening price of potentially bearish candles. Right? And note this down. Open, turtle soup into previous candle's low, CRT, and rally when bullish, and vice versa. Open, rally, turtle soup, and then dump. FVG. FVG is a 3-candle pattern which indicates one-sided heaviness in any given market, right? Which means the market makers are pushing price low so quick and they're in such a hurry to go down to attack a certain target that they're leaving these gaps in the market. And these gaps are rich and filled with leftover orders which need to be rebalanced. And that's the reason why FVGs are always sensitive price zones in the correct order flow. Right, so in a bullish candle, you'll see FVGs being wicked into. So a quick wick, FVG, wick and rally, CRT low, and vice versa. FVG bearish, they'll go and if it's a valid FVG, then you'll see the reaction. You'll see it dump straight down without spending too much time in the FVG, right? Which is an important factor. The speed from the key level. Next up, we have the breaker block. Now we have the bullish breaker, and we have the bearish breaker. And the bullish breaker is the up-close candle that caused the bearish turtle soup. Right, so it's one specific candle. Again, remember the difference between what we do and what the other schools of analysis do. We're not here trading zones. We're not here guessing zones. We're not here like the supply and demand traders, like the market structure, ETFX, all those clowns. We're not like them. We trade specific candles, not zones. All right? So the breaker is this one specific up-close candle which caused the dump. As soon as you close above the candle, then the sensitive point in the breaker is going to be the closing price. It's always going to be that way. And this is one of the ways to achieve near to zero drawdown entries. Is the breaker's closing price. Right, and go back in the charts, verify yourself. What I'm saying is the closing price of the breaker, of the valid breaker, is one of the best ways to get a zero drawdown to the pip to the tick entry. As you can see in this picture here. And vice versa with the bearish breaker. It's the down close candle that caused the bearish turtle soup. This one specific candle, preferably a thick, clear, visible candle before the rally. Again, we take the whole candle, and the sensitive point is always going to be the closing price of the breaker. Right, so it's going to be down on the bearish breaker and up on the bullish breaker. Usually, more often than not, that is where they offer you a zero to the tick entry, zero drawdown entry, which will be spoken about later in the next chapters. Kill zones only applies for day traders, and also applies for the weekly candle trader when trying to catch the high or the low, because the high or the low of the week usually forms on a specific day at a specific time, usually, more often than not, during a kill zone. A kill zone basically is a high probability trading window. It's a window of time in which price moves faster. We have three main ones: the Asian session, usually which we leave and don't trade. We watch what the Asian does in order to anticipate London. So the Asian session is 8 p.m. to midnight New York time. Whenever we talk about the algorithm, we're talking about New York time. Right. So whenever I say time, whenever I'm trying to tell you something on the chart, then the time that unifies all of us is New York local time. Right? That's the time which matters to the algorithm. So Asian, 8 p.m. to midnight. London, you have 1 a.m. to 5 a.m. New York, 8:15 to 2 o'clock. Now there are some adjustments which can be made to these times, but this is the rough estimate, and this was intended to be a quick, brief run through. We'll go in deeper into exactly what time to enter later down the road. Right, but for now, these are the kill zones. High probability time windows in which price moves faster. And a phenomenon for your study is session liquidity, which is, what does New York do when a turtle soups London's liquidity? And vice versa. Right, so each session is taking the liquidity of the previous session and moving in a certain pattern. That's what we're trying to predict. right? So the market makers are using the sessions to generate liquidity, and they're using each session, to move the market in a certain way depending on which liquidity it took first. For example, if we had taken this high before this low, then more often than not, that would be a bearish sign. And vice versa. We took this low, they pushed price down below this low, they rejected, they closed above this candle, model number 1, rally. Next up you have the famous model number 1. Now model number 1 it simply refers to the up close candle that liquidated the high, or the down close candle that liquidated the low. This one specific candle, again, you'll notice this pattern in my speech, which is speaking about one specific candle in each trade. That's the precision we aim to have, which is way above anything else. We go and dissect specific candles and pinpoint specific candles, not zones, right? Which is what makes the system better than other systems, objectively better and objectively more accurate than other systems. So a bearish model number 1 is an up close candle that liquidated the high. You enter at the low, stop loss the high, and you let it dump. And vice versa. A bullish model number 1 is the thick down close candle that liquidated the low. You close above it, and then you use that single candle as a sensitive price point to enter. Now what's happening in model number 1, it's not just a pattern. It's the market makers pushing price, enticing new orders and new liquidity into the market, right? Because that's how they generate interest in the markets, is by pushing price higher or lower, enticing dumb money to get excited and participate in a trade in the false direction, right? So in this situation, they're forcing price above the old high, enticing new longs, stopping out old shorts. And as soon as they close below this one specific candle, they're showing intention of using this one specific candle as the trap and as the propeller to push price into the other way. So they push price into the high. They lose money temporarily, pushing price up in here. They close below, and they have to push price back into this one specific candle in order to push price lower, right? They can't go lower unless they go and mitigate the risk that they have by pushing price into this one specific up close candle that liquidated the high, and then they're forced to push lower, which is also CRT. Right, now that was a bit too, I went a bit deeper than I was intending to in the summary. But in plain English, bearish model number 1, up close candle, liquidated the high. Bullish model number 1, down close candle that liquidated the low. Next we have turtle soup. Pretty simple. So we have buy orders, sell orders, market makers pushing price above the old high, stabbing into the buy orders to entice new longs and to stop out old shorts. And once they have this move done, then they're going to offload the positions they gathered up here and dump them and distribute them to this old low, right? So market makers, they need old highs and lows. This is the advantage we have over them, is we'll know that they will always need our highs and lows in order to accumulate, manipulate, and distribute. You can't manipulate unless it's above an old high. There will always be old highs and lows, which they need and they engineer and they manipulate above and below in order to make money, right? So this is the advantage we have, which will never change unless the markets are taken away from us, unless we can't trade anymore. That's when it's gone, which is not going to happen anytime soon. All right, and vice versa. Bullish turtle soup, they engineer a low. So this low, price pushed away from this low, right? So they propelled price away, generating automatically. You can assume when you see price moving higher that there's sell stops below it, right? Below the old low. They push price down into the old low, stopping out everyone who was long, right? Adding new short positions in the market, and then using that fuel to push higher and make some money. They make some money out of the retail traders, right? So that's basically turtle soup. Rejecting old high or rejecting an old low in plain dumbed down English. Rejection block. It's a nice one. It's the closing price of the candles, the closing price of the order blocks when they leave either a stubby or a long wick. Right. This will be discussed in detail in the lesson Price Action Details later. But it's basically when you see an order block with a long wick, right, then you're going to go and mark the opening price, and that usually is the sensitive zone which they use to stab into, stop out retail without taking out the wick, and then dump, or vice versa. So retail and dumb money turtle soup traders, they think, you know what, I'm going to wait for this low to get taken. But no, the body is enough. They take the body and they rally. OTE. OTE is basically a golden zone Fibonacci pull, which is terms which I don't expect any ICT trader to understand, because they're all just blind cult following sheep, which can be a good thing, right? But the way they're pushed into watching his 50,000 hours of videos for his own benefit, right? And I mean ICT. That's what I have an issue with. So, excuse me for the rant. The reason I'm bringing this up anyway is their lack of critical thinking skills. You can know what an OTE is by simply Googling Fibonacci Golden Zone, right? That was where the OTE was taken from and repackaged, basically. But the good thing is, and I digress from that little mini rant, the OTE is a lot more simplified version, which is easier to understand, as you'll see right now, which is basically low, high, low, right? So you have a low, you have a high, you have a lower low, and then you have a higher high, which closes above the high that broke the low. Right, so once again, snap out of it and focus. Low, high, lower low, caused by the high. And then the high that broke the low, you're going to close above it. Once you close above this high, close convincingly, then the games are on. The bullish games are on. You wait for a pullback, and this is the OTE. It's the pullback, right? So it's a deep retracement, which they use to scare away people after the market sentiment has shifted from bearish to bullish or vice versa. So as soon as this happens over here, we have switched now to bullish. And this is a mid-lecture reminder. If you're strayed away or you got distracted or you went to sleep, then wake up and focus. Back to noting down the important things, which is low, high, lower low, close above, higher high, and then after this close, this is where dumb money buys above old highs. And even though they're right about the direction, they get viciously taken out of the game, and then it rallies, right? So the OTE in basic terms is the pullback used by the market makers to scare away people who are on the right side of the market, but they're not familiar with how the market moves. And it must have happened to you. At least all of us have suffered and experienced this once. At least once is you were right that the market is going to go down, but you kept on waiting for it to go down from here, and you shorted down here, you sold down here, and then it went up. You then doubted your analysis, only to be proven right at the end, right? So you were right, but you were unfamiliar with how price moves, which is why you made no money. Right, so again, high, low, higher high, dump down viciously, OTE, which is a 50% to the 75% Fibonacci level. That's what I consider an OTE. And I even extend it over to the 0.886 Fib. Right, so anything after the market structure shift, and the OTE is one of the most beautiful trades you can take. One of the most surefire, beautiful trades you can take is it's the deep retracement after a market structure. And note this down. OTE is defined as the deep retracement after a market structure shift, either bullish or bearish, designed to scare away the people who are on the right side of the market. Usually lies from the 50% Fib all the way down to the 0.886 Fib of the price leg. Right, so leg 1, retracement, leg 2, OTE, vice versa. Leg 1, retracement, OTE, kickstarts leg 2. Right, so they distribute in 2 legs, 2 expansive price legs. Expansion leg 1, once you see this, then you're almost guaranteed, and there's no guarantees in the market, but there's a high chance that you see a leg 2 kickstarted by OTE. Right, there you have what's that? There we have a rejection block. To finish off this terminology lesson, which has gone a bit farther than I wanted, SMT. Now, SMT is when one asset class takes the low, the CRT low, and the other asset class doesn't take the low. And that usually indicates heaviness in one specific asset class over the other. And this is a concept first developed by Charles Dow back in the late 1800s. It is not an ICT concept. It is not a new magical IPTA SMC invention. It's old as the hills. Right, which is the idea that the market makers are going to push price below one specific low and not the other one to send each other a signal that the bottom's in. Right, so in plain English, SMT is one asset class taking the low, and the other asset class is not taking the low, which indicates weakness in this asset class and indicates the lack of desire to go any lower, right? So this is the cheapest they want to offer this asset class. Right, so ideally, you're going to go and you're going to buy the asset class which is refusing to go lower in a bullish market, and vice versa. I hope you found that insightful. That marks the end of chapter terminology. Wish you good luck, good trading, and see you in chapter 2.